Okay, it's 11 o'clock and we can get going, I think. Thanks for bearing with us while I've been away. This week I've got a bit of news to run through as normal, and then I'm going to be talking to Mark Shepherd from Manchester and London. News-wise, three things that I pulled out from this week. I know it's only a short week, but nevertheless. European opportunities, Chrysalis and Chelverton UK Dividend. And European opportunities first. This 5-year chart. Doesn't look too bad, but as we'll see in a second, it's lagged the sector and its benchmark. The discount is relatively tight, and that reflects, I think, what's going on. And you can see here, this is in the context of its European peer group. The 3-year and 5-year and 6-year numbers, 10-year numbers are not looking great, as you can see there. The better gift European growth is worse in many respects, but nevertheless, European opportunities has disappointed, and that's reflected in its share price returns too. And when you look, this is taken from its fact sheet to the end of April, you can see that it's lagging the MSCI Europe by quite a margin over most time periods, and you can see that too on that chart there, where MSCI Europe is the grey line at the top. And so not great, unfortunately. Because of all that's been going on, it's been trying to tackle the discount and everything else for a while. Saab built up a stake in it. Back in October 2023, it said, we're going to do a conditional tender offer that would be triggered if we don't beat the benchmark over the 3 years ending the 31st of May 2026, so this time next year. Saab still said it would vote against continuation, but actually European Opportunities won its continuation vote at that time. Nevertheless, it did offer an immediate 25% tender and 2% discount then, and that was taken up in full. And then in February this year, it said it would do another one on the same kind of terms. So the details of that were announced yesterday. So the tender's up to 15.5 million shares. It's at NAV, less costs, less 2%. To qualify to participate, you're going to need to be on the register on the 17th of June. There's a meeting to approve it on the 3rd of June. I think they'll just sell through. And the tender forms need to be in by 1 p.m. on the 17th of June. We should know the results of that on the 19th. And the cash for those that tick the cash box will arrive on the 27th or thereabouts. So just before we move on, I think the discount's tight enough now that there's not an enormous uplift to be got from tendering shares, although there is a small one. I still think there's a good chance that's going to be taken up in full, though. We're going to have to just wait and see what happens with that. Chrysalis next, and there's the 5-year chart for that one. And as we can see, it did amazingly well until interest rates started to rise and then fell off a cliff in terms of the share price, and the NAV retreated too, but the NAV has been sort of edging up, albeit not in a straight line, for a couple of years now. And the discount is still way too wide, although it's not as wide as it was. So they announced this week the Q1 NAV. So that was a small drop from the level at the end of December. But since then, they've announced they've done another sale. So InfoSum, that added another 1.2p to the NAV. So, and most of the fall that we saw in Q1 was actually down to currency moves rather than disappointments in the portfolio. In fact, the underlying portfolio seems to be doing okay. As they say there, about 88% of the portfolio is now profitable or break even, and that contrasts with about half that this time last year. The big change recently has been restructuring WeFox, which has been a sort of problem child, but they do think that's now sort of back on more of an even keel. We were hoping that we'd see an IPO of Klarna, and indeed that was all geared up to go before Trump did his thing with markets and basically derailed the whole thing. But given that things have recovered, there may now be a window of opportunity for that to go ahead. I think things have to settle down a little bit, but we'll have to see. Regardless of that, they've now got a decent chunk of cash that they are in the process of returning to shareholders via their capital allocation policy. And they've bought back now just about 10% of the shares that they started with since that was announced in October 2023. And the total commitment is to return £100 million in total. And even when they've done that, under the existing plan, they continue to hand back at least 25% of net realised gains. And they've also confirmed more than once that they're not planning to make new investments at the moment. So we have seen a number of disposals now, and most recently with the InfoSum. These are coming in at premiums to the carrying value of these things, which is all good. As I say, Klarna, if it happens, would be transformative in terms of the freeing up the cash, although we don't know, there's no way of knowing what sort of price it's going to fetch, given the volatility of the markets, but there it is there. So I do kind of think that is starting to work. I mean, with all of these funds, the growth capital type things, they do tend to have problems that come to light quicker than things come good. So we into the lemons ripen first type scenario. And you've definitely seen that with Chrysalis, but you are actually still seeing some good news coming through. And they do have quite a lot of interesting investments still. Nevertheless, AVI has written to the board asking for the continuation vote to be brought forward by a year. And it wrote a letter and got that co-signed by investors who collectively hold 27% of the votes. The board is not keen to do that, but it's instead suggesting that maybe we have a vote at the 26th AGM to confirm the capital allocation policy as it currently stands, or maybe to tweak the capital allocation policy if the circumstances suit at that point. And they've been talking to shareholders anyway, and there's a variety of views. So there are some investors who don't want any new investments to be made, whatever happens. There are some investors who want all money handed back at NAV. There are some investors who want the investment management contract changed so that the managers are incentivized to realise the portfolio. There's some asking for a share class structure, which I'll talk about in a second, and some saying the board needs to change to reflect the views of some shareholders. Now, the board is going to go out and they've asked Rothschild to do a new shareholder consultation looking at specifics around this, and we'll see what the feedback is from that. But my feeling is that I don't see any merit in bringing forward a continuation vote. Basically, things are being realised anyway. I don't think you can realise them any faster, realistically, without destroying value. I don't see that there's any upside in just flagging Chrysalis as a forced seller of assets. I don't see why anybody would have a problem with the existing board. They've been quite proactive. They've renegotiated the fees, for example. They put in place this capital allocation policy. They listened to shareholders and done stuff, and they're clearly open to talking to them again. So I don't see why you'd need to change the board at this stage. The only thing that I do wonder is whether once you've achieved the 100 million return target, whether you could think about asking investors, do you want to create a realisation share class? So basically, you'd run two portfolios effectively. I mean, the same portfolio, but two sort of lines. One where all the money would be returned to shareholders under realisation share class, and one where new investments would be made. I think there's a good case for Chrysalis to make new investments. I think the managers have demonstrated that they can identify interesting companies that are worth investing in. But I think that needs to be put to shareholders and they need to make a choice. I think 10 years from launch is 2028. So in the run up to that, so 2027 is the right sort of time to be asking those sort of questions and making those sort of decisions. And I don't see the point of trying to rush that. Chelverton UK Dividend, tiny trust now, 30 million market cap, relatively narrow discount, very high yield. But it's always been run with this structure where it's had gearing in form of zero dividend preference shares, and they help enhance the income. And they've been running this sort of basically launching a new zero issue every time the old one matures. They've been trying to do one now in April, and it failed. And that's really down to the volatility of markets. Although it's quite surprising given how high the gross redemption yield that they were offering was, 7.5%. Nevertheless, they haven't been able to get it away. So they've had to repay the old 2025 CDPs with cash. And that is what's shrunk the portfolio down to just north of 30 million. Because you don't get the uplift from having the gearing invested in the portfolio, and they are going to have less income, so they're going to have to cut the dividend, and they've suggested cutting that from 13p to 10p, which brings it back to a yield about 7.5%, 7.6. And even then, they're topping that up with transfers from capital, which they can do for a while. They've got 2.8 million of reserves. They say they're going to look at alternative financing. They make the point that their small cap portfolio, the stocks are cheap and interest rates are coming down, which will play in their favour. Nevertheless, you can see how the performance of small caps has been holding it back recently, and you can see that in the 1 year and 3 year numbers there relative to the rest of the UK equity income sector. And I do think it is too small. The big sort of negative around that is that the ongoing charges are too high, so they're at 2.7%. Obviously, that's eating into the income too. And if they're thinking about going down the route of putting in bank debt in place of zeros, that really just makes the whole thing much more risky, because bank debt comes with covenants and you get big moves in markets and then you have to start trying to repay it at the bottom of markets. You don't have that problem with zeros. And I wouldn't be as inclined to see them go down that route. So I think it's more of a case of maybe looking for merger partners now, and there isn't anything directly comparable, definitely nothing with that same kind of very high yield. But there are things like diverse income, perhaps, or there are other bits and pieces that might fit, but I don't think he can carry on going as is. Right, that's me.